Welcome to the deep dive.
Okay, so you've brought us this really interesting stack of sources today. It's kind of a greatest hits list, right? 10 key personal finance lessons from a pretty popular channel.
That's right.
And our goal here isn't just, listing them off. It's about really getting into them, giving you that financial philosophy shift you can use almost immediately,
Yeah.
like tomorrow.
Exactly. Think of it like a shortcut, maybe. A shortcut to getting financially clued in. We're pulling out the actionable stuff, the behavioral pieces.
Right.
This isn't about, which stock is hot this week. It's more foundational. It's about the mindset, the systems, the things that actually build a stronger financial future over time.
Okay, great. So let's jump right in then. We've kind of grouped these 10 lessons into 3 main areas to make it easier to digest.
Makes sense. First, we'll hit the mindset stuff, long-term thinking. Then we get practical. Tracking, spending control. And finally, we'll look at strategy, saving, and passive investing. All right, so lesson number 1. This feels like the big one, the foundation for everything else. Delayed gratification is crucial. We hear this constantly with investing, right? Buy and hold. Don't touch your 401k. Let compounding work.
Yeah, absolutely. But what I really liked in the source material was how it brought that big idea down to a really simple everyday rule.
Oh, yeah. What's that?
The rule is just, if you can't buy it twice, don't buy it.
Huh. Okay. That's actually pretty powerful. It forces discipline instantly, doesn't it? Like building in a buffer.
Precisely.
Yeah.
So you want that, say, $500 gadget or piece of furniture. Ask yourself, how does the thought of spending $1,000 on it feel?
Right.
If spending $1,000 on that one thing feels really uncomfortable, maybe even a little sickening, then you probably can't truly afford the $500 version right now.
It ensures you're buying from strength, not just barely scraping by.
Exactly, not just marginal affordability. And, this mindset isn't just about buying stuff. It plays out in huge life decisions, too.
Like career choices.
Yeah, the source had a great example.
Yeah?
Someone was thinking about leaving a job they liked, something with long-term growth for maybe a 10K or 20K bump in salary,
Yeah.
but in marketing.
Okay.
But they stopped and thought, okay, fast forward 10 years, 20 years, do I really want to be doing marketing? And the answer was no.
So they delayed the gratification of the higher salary for the better long-term fit.
Right. Resisting that easy, quick dollar often takes real discipline. Delayed gratification.
And resisting that, it really takes self-awareness, knowing what you actually want, which leads perfectly into lessons 8 and 9. Avoiding comparison traps. You can't delay gratification if you're always looking at what others have.
Oh, the comparison trap. It's just,
Right.
it's lethal for your savings rate.
Yeah.
Seriously. It eats up time, mental energy, and worst of all, it pushes you into impulse buys.
Yeah.
Because you're trying to look successful based on what you think other people are doing or have.
Yeah. We definitely all see that online, or maybe even with friends. That perfect high-spending lifestyle.
Well, that's exactly what Lesson 9 calls out with this brilliant term, the 30K millionaire.
Haha. Okay, what's that?
It's the person making, maybe $30,000 a year, but living like they're rolling in it, projecting wealth that just isn't there.
Oh, I know exactly who you mean. We've all seen that person.
Yeah, maybe they're driving that flashy BMW, right?
Yeah.
But they still live with their parents because they can't swing rent and the car payment.
Or buying the VIP table at the club, but then nursing one drink all night because they can't afford more.
Exactly. It reminds me of that quote from The Millionaire Next Door, something like, if your motive is to make money, to spend money on the good life, you're never going to make it.
Ooh, yeah.
True financial health means focusing on quietly building, not loudly spending.
So, focus inward. Which brings us neatly to lesson 10, customizing your risk profile. Just because everyone else is doing X doesn't mean you should.
Correct. You need a filter. All financial advice, even what we're talking about right now, needs to be run through your personal filter.
Right.
What's risky for one person might be totally fine for someone else with a different income, different debts, different goals. You have to think critically. Is this right for me?
It's the final check. Are you doing this based on your plan or because you're reacting to that 30K millionaire next door?
Precisely.
Okay, so mindset dialed in.
Yeah.
Now for the mechanics. Lesson 2 says there's a non-negotiable step for long-term freedom. Track 3 key numbers. The source calls them the big 3.
Yes. Expenses, savings rate, and net worth. Tracking these consistently basically guarantees progress over time.
All right, let's break those down. Expenses first.
Okay, so expenses. You've got your fixed costs and your discretionary or variable costs.
Fixed being like rent, mortgage, utilities, insurance, the must-pays.
Exactly. And the big rule here is Those fixed costs should ideally not eat up more than 50% to 60% of your income.
50 to 60%, okay.
Yeah. If you're consistently over 60%, it's brain sign. Your basic cost of living is probably too high for your current income. Makes everything else really dicey. Squeezes out savings.
Okay. And then there's discretionary spending, the fun stuff, but also where things can go off the rails. How do we manage that?
The source had a good tip.
Yeah.
Do mid-month check-ins. Actively look at it.
Mid-month? How does that work?
Well, say your target for discretionary stuff, eating out, hobbies, whatever, is $1,500 for the month.
Okay.
Around the 15th, take a look. Are you near $750? Great. But if you check on the 15th and you're already at, like, $900.
Uh-oh.
Exactly.
Uh-oh.
But it's actionable?
Uh-oh.
You know right then, okay, I need to pull back for the rest of the month. It stops those Nancy surprises when the credit card bill hits.
Smart. Prevents the end-of-month panic. Okay, what about the other two big three?
Savings rate. Pretty simple. Aim for 10% of your income to start, then push it higher as your income grows or your expenses drop. More savings rate means more fuel for investing.
Got it. And net worth. That one seems like it could be stressful watching it bounce around.
Yeah, it could fluctuate for sure. The key is tracking it mainly for perspective. For peace of mind, actually.
How so?
Looking back at your net worth tracker from, say, 2020 or 2021, remember those market swings? Seeing how it recovered and grew despite the bumps? That provides incredible motivation. It shows the long-term progress is real.
Ah, I see. Focusing on the trend, not the noise. Okay. Now, speaking of things that drag down net worth, lesson 4, a big warning sign. Beware of depreciating assets. We all know cars lose value the second you drive them off the lot. But the list is longer, isn't it? Jewelry, watches, fancy clothes, phones, computers, even furniture.
Yes, and the absolute crucial takeaway here, the thing you really need to internalize is never borrow money to finance depreciation.
Wait, say that again?
Yep.
Never borrow for something that's losing value.
Exactly. Think about it. You're literally paying money to lose money. You take out a loan, probably high interest, right? So you're paying extra to the lender. And at the same time, the thing you bought is worth less and less every day. It's just a terrible financial trap.
That furniture example from the source really hit home.
Oh, yeah. That $2,000 trendy couch, you use it for 3 years, then you move or redecorate. You try to sell it online.
Good luck with that.
Right. If you're lucky, maybe you get $200 for it on Facebook Marketplace after dealing with 50 people ghosting you. So that's an $1,800 loss right there. Plus, any interest you paid if you financed it. Just avoid borrowing for stuff that drops in value like a rock. It's key for control.
All right, moving into the long game, the strategy. Lesson 6 starts with something that really made me pause. It says that at the very start of your financial journey, saving isn't just important, it's actually the most important thing. More important than returns.
Yeah, it kind of challenges that idea that it's all about picking the right investment from day one, doesn't it?
It does.
The sources really emphasize that the hardest part, the real friction in building wealth, is right at the beginning. In those early years, how much you save actually moves the needle way more than your investment returns do.
Wait, really? Even with compounding, the actual amount you put in matters more initially?
For the first few years, yes, absolutely. The math they showed was pretty stark. Let's say you save $13,000 a year for 6 years, and you get a decent return, like 7.5% on average.
Okay, that's a solid return.
Right. After 6 years, your balance would be around $101,000, which is great. But here's the kicker. 77% of that $101,000 came directly from the money you saved, your contributions, not the market growth.
Wow. 77%.
Yeah. So that initial grind, that discipline to just save consistently, that's what truly builds the foundation. Diligence in saving is the accelerator early on.
Okay, that's a powerful reframe. So once you've built that base through saving, then we focus on investing. Lessons 7 and 3 guide this, saying it should be, well, simple and kind of boring.
Yeah, boring is good here. Long-term wealth doesn't usually come from thrilling, high-action stuff like day trading. It comes from dull things like buying and holding index funds.
Morgan Housel, who wrote The Psychology of Money, had a great quote in there about this.
He did. He said the best strategy is about maximizing endurance. If you could just earn average market returns, but do it for an above-average amount of time,
You end up way ahead.
way ahead,
Yeah.
like top 5% of investors ahead, just by being consistent and patient with average returns. Boring leads to exceptional results, paradoxically.
And lesson 3 ties into this. Don't overcomplicate it. Keep it simple. Don't invest in too many things.
People think more funds or more stocks equals more diversification, equals smarter investing. but often it just means more complexity.
Like holding 10 different ETFs that all basically own the same stuff.
Exactly. The Force used the example of two Vanguard ETFs, VO and VOE, mid-cap and an S&P 500 equivalent, basically. They looked different on the surface.
Get under the hood.
They had a 92.1% overlap in the companies they held. So you haven't really diversified much. You've just made your portfolio harder to track and potentially worse for taxes.
So the takeaway is keep it simple. Broad market index funds. Buy them. Hold them.
And the data backs this up so strongly. Over the last 15 years or so, if you, as a casual investor, just bought an S&P 500 ETF and held onto it, you would have outperformed 92% of professional, large-cap, active fund managers. 92%.
Wow. Just by being simple and doing nothing.
Simplicity is a financial superpower. It really is.
Okay, simple investing, but you also need patience. Lesson 5 hammers home the power of time, the 20-year horizon.
Yeah, this one is incredibly reassuring, I think, especially when markets get choppy.
What's the core finding?
Looking back through history, over any 20-year period, U.S. stocks have never delivered a negative real return. Once you factor in dividends and adjust for inflation, no 20-year period has lost money.
Any 20-year period, that's a long time horizon, but it's powerful.
It is. And it basically makes trying to time the market based on short-term valuation metrics like the PE ratio almost pointless for a long-term investor.
Right, the PE ratio, price to earnings, that thing people use to say the market is too expensive or cheap.
Exactly. And trying to use that to decide when to jump in or out, it often leads to sitting on the sidelines and missing out.
Like the example from 2012.
Perfect example. Go search online for stock market overvalued 2012. You'll find tons of articles, experts warning the market was way too pricey, maybe 50% overpriced.
And the S&P 500 back then was trading around, what, 1,400?
Something like that. Imagine if you believed those warnings back then and stayed in cash because the PE ratio looked high. You would have missed absolutely massive gains over the next decade plus.
Ouch. Yeah. Time in the market, not timing the market.
Always. #outro.
Wow. Okay, that was a really efficient run-through of some seriously powerful financial ideas. 10 lessons boiled down. If you pull it all together, the core message seems pretty clear, doesn't it?
It does.
Practice discipline, especially saving first. Embrace simplicity, like radical simplicity in how you invest. And then just be patient. Really patient. Trust that 20-year rule.
Yeah, and what really stands out to me, listening back, is how Lesson 10, customizing your risk profile, ties directly back to Lesson 8, avoiding comparison. They're like two sides of the same coin.
How do you mean?
Well, the biggest threat to your financial plan probably isn't a sudden market crash. It's making choices based on what you think other people are doing successfully.
Instead of running it through your own personal risk filter. Based on your own goals.
Exactly. It comes back to defining success for yourself, right?
Yeah.
So the practical advice is focus. Focus hard on your big three numbers. Your expenses, your savings rate, your net worth. Not theirs.
Right.
If everyone around you seems to be living that 30K millionaire life, financing depreciating assets, should that make you feel like you're missing out? Or should that maybe be a warning sign?
A signal to double down on your own plan.
Exactly. Based on these sources, the winning move is to tune out that noise. Focus on the quiet, consistent discipline that actually builds real wealth over the long haul.
Okay, so here's something for you, the listener, to chew on this week, building on that. What financial decision are you maybe putting off right now because you're comparing yourself to others when deep down you know it's the right move for your situation, your customized risk profile? Something to think about.